There are risks, but at the moment I think those risks are pretty minimal. We've seen increasing overseas capital coming into the London markets and the West End market itself over the last 2 years, and I think in 2010 it was about 55% of total volumes invested were from overseas. In 2011 that had increased to over 65%. So there's been an increasing trend from overseas investors to want to acquire West End property. And when I say West End property, it's mainly focused, I must say, on the core markets, Mayfair, St James's, and principally freehold. They love London, they love the structure, they love the legal structure, they love the visibility, the liquidity of our market here, which makes us relative as a place to invest when you compare it to other global centres, particularly Paris and New York, which tend to be the other two markets which they look at. It makes London look relatively attractive. The visibility and the ability to actually buy here, and you can buy quite quickly if you want to, makes us an attractive place to invest. Now, investing in London, will it recede? It's all relative to other markets. At the moment, I think London offers quite a solid platform outside the immediate Eurozone countries, and I don't think that is going to change in the short term unless other markets become more attractive. And when one looks at yields in other global centres, which are where big investors want to place their money, London actually offers relatively attractive returns compared to other centres. Investors in London fall broadly into two categories, those from overseas and those from the more domestic, more traditional institutional and property company players who have been in the UK and focused on London for some time. In terms of UK players, these fall broadly into institutional investors and property companies. Now they are looking more for your traditional buy outside maybe the core of the West End, either core Mayfair and St James's, which has really turned into preserve high net worth individuals and overseas buyers. Domestic players are looking for opportunities where they can generally reposition assets, buy properties which are maybe grade B, turn them back in through refurbishment into grade A, and look to capture what we believe is going to be some pretty good rental growth over the coming years. 2012 is likely to be a relatively flat year in terms of rental growth in the West End, but the prospects for 2013 through to 2016 look to be quite good if the forecasts are proved to be accurate. London GDP looks to be attractive compared to the rest of the UK over the next few years, should see the demand side of the equation pick up. The supply side is very tight, as we know, on the occupational market. Therefore, we see rents increasing. And I think the interesting places to invest outside the core, particularly places like Soho, north of Oxford Street, should see those UK players look to invest in those locations in more increasing numbers. The overseas market is looking for its traditional buys. It's looking for good quality buildings in good quality locations and principally freeholds. They look to actually buy property which is relatively risk-free, relatively management-free, therefore not too over-rented, not too short income. It's interesting, the last 3 deals we've seen in the Mayfair market, for example, in 2012, have all been bought by private European investors. A German investor who bought Stratton House, and a Swiss investor who bought 1 Berkeley Street, and a private Italian investor who bought Queensberry House. Now those 3 deals are all over 150 million, and the reason that they've been bought by private European investors is they can actually take yields which are sub 5%. The overseas market in Asia dominated capital, looks for returns of about 5.5 plus. So I think we're not really going to see a huge amount of change, but the bigger ticket deals seem to be preserved of the overseas buyers, with the UK domestic players looking for sub £100 million lot sizes. I don't think any London asset classes are looking particularly overpriced at the moment. You only have to look at the demand for all types of asset classes across London. Take residential demand coming from Asia, where properties seem to sell off-plan very quickly, and there's high global demand. Look at the returns that investors are now looking to achieve from changing offices to residential in Mayfair. Gives you some idea of how people see central London residential going to perform over the next few years. Hotel growth is set to remain pretty good. RevPAR growth over the next few years, where there's an Olympic effect as well, which will boost that, remains to be seen. But generally, people feel pretty buoyant about that sector. Retail is doing very well. Very few voids in central London across the key streets of Oxford Street, Bond Street, and Regent Street. And all three of those streets, particularly Regent Street, has seen some phenomenal rental growth in terms of Zone A's over the last few months and years. So I think all three of those big streets, principally on retail, are set to perform pretty well. And investors are clamouring to get into those. One only has to look at Bond Street and see yields now which have gone sub 3%, which gives you an idea of the scarcity of products in those in that high fashion area, and the desire of investors to own what is a freehold on a street which is undersupplied in terms of units. Looking at the offices side of life, I think it still offers attractive prospects. London, as we know, is set to benefit from some good rental growth over the next few years, and therefore the returns look to be set fair and was going to certainly outperform other areas and other sectors over the UK and other parts of London. So I think generally the market looks fairly priced at the moment, and I cannot see any real risk for investors to why that performance shouldn't continue over the short to medium term.